Hello and welcome back to Dukascopy TV. It's time for another episode of Hollenbeck Unleashed. Dr. Frank Hollenbeck joins me in the studio now. Frank, thank you very much for coming in.
Good to be here, Natalie.
Now, we touched on it last week, but over the summer you were terribly busy writing lots of articles, and we in fact got one of them up here, the 3 types of austerity. Now, Frank, can you give us sort of a quick summary of what you wrote?
Well, what I say in this article is somewhat obvious. What I say is that growth will come from the private sector. It will come from private investment. And the type of austerity that we need is austerity that increases the size of the private sector relative to the public sector. And what I say is that the austerity we've implemented in Europe is just the opposite. There was a study done by Konstantin Gurdjieff of Trinity College in Dublin that looked at government expenditures as a percentage of GDP in 2012 relative to government expenditures as a percentage of GDP, the average level between 2003 and 2007. What he found is that only Malta, Germany, and Sweden actually had reduced the role of government. Everyone else had increased the role of government relative to the private sector. Okay, and we can see that in the case of Greece. Okay, Greece, although its public sector has been declining, it's been declining at a slower pace than the private sector, so that the role of the public sector has been increasing. For example, they've lost 500,000 jobs since the beginning of 2008, but they've lost relatively few public sector jobs. They've been talking about cutting 500,000 public sector jobs, but they haven't really cut much. For example, they've recently made a pledge to cut 12,500 jobs this year and 15,000 jobs next year. Not only this is too little too late, it's also still only a pledge. If we want to look at the type of austerity that's been successful, we should really look at Latvia, that reduced the public sector from 44% of the economy to 36% of the economy. The important thing is that they increased the private sector, or the private sector share of the economy, from 56 to 64%. That's why they've had GDP growth over 5% in 2011, 2012, and probably in 2013.
Now, one of the next big stories of this week, tomorrow we will find out if the Fed are going to initiate tapering or not. We've got it there, the big T. Frank, what's your view on this?
Well, I don't really think that 10 or 15 billion is a lot of tapering. But we do know that when the Fed starts tapering, we can expect a serious adjustment. An example is 1937. When the U.S. government set the price of gold at $35 an ounce in 1934, it induced a large inflow of gold. Okay, and this inflow of gold caused the money supply to increase significantly, 12% in 1934, 1935, and 1936. Okay, and by the end of 1936, the government started getting worried that it was losing control over inflation. Okay, and it decided to sterilize the gold inflows. So in other words, gold was coming in, they were putting money into the system, then they sold bonds and took the money out of the system. So what happened is monetary growth went from 12% to 0%. Okay, that's just basically lightly tapping on the brakes in terms of tapering. Okay, anyone who considers that to be excessive basically is saying that you need monetary juice in a capitalist economy. We have ample evidence in the 19th century that we had significant amount of growth with a stable money supply. Never forget that money is a measure of value, and it serves its function best when it is stable. Okay. Now, this tapering in 1937 actually led to a stock market crash and a collapse of the economy. Industrial production dropped 32%, GDP dropped 11%, and unemployment went back from 14 to 19% that year.
Now, almost opposite to the stock market crash, we've seen stocks have a summer's rally, really, off the back of news that Larry Summers has pulled out of that Federal Reserve race. Stocks seem pretty pleased then that Janet Yellen is once again favourite for this position. What's your views here?
Well, my view is that it's really quite irrelevant who's going to be the next Fed chairman, because we know what his position will be. In other words, to be appointed by the president or by Congress, the first thing they're going to ask him is, are you going to continue to monetize the debt? So in other words, we have a situation where the only person who's going to be put in that position is one who basically supports the government's current borrowing binge. Okay, and this is just the opposite of what central banks are supposed to do or be set up as. Okay, our ancestors made sure that the government could not influence the printing of money because they realized that it's just simply too much of a temptation to print money to finance government expenditures. We now currently see that the Fed has been basically captured by the government, and that's not the way things should be.
We've also got, lastly, the upcoming debt ceiling. Again, go on, hit us with your thoughts.
Well, I think we talked about this last year, and we talked about the fiscal cliff at the beginning of the year. And I've always told you the same thing, is that you have like two fat people deciding to go on a diet, but don't really want to go on a diet. And for them to be induced to go on a diet, they need something like a heart attack. And the problem we have in the U.S. is there's no pain. The central bank is going to purchase almost 100% of newly issued bonds. Interest rates are not going to go up, okay? And the government needs to have higher interest rates to feel pain, to actually take the fact, to actually be serious about reducing its current borrowing, which is hitting $17 trillion very shortly.
Frank, thank you very much.
You're welcome.
Dr. Frank Hollenbeck there, indicating there's no gain without pain. We'll be back shortly with more exclusive interviews for you. Goodbye for now.